Welcome back everyone, I'm Philip here from BlackBull Markets. Hope you're all doing well. In this video I want to talk to you guys about scaling in on your trades. What are the right ways, what are the wrong ways, because there is a common error in scaling in where you can overtrade. So make sure to stick all the way through to the end of the video to figure out how to prevent overtrading when you do scale into a trade and how to use this technique properly to get the most out of the market. So also make sure to smash that like button guys and subscribe to the channel if you're interested in learning more about Forex and improving your current trading skills. So without further ado, let's have a look and see how we can get this technique down properly. Okay, so first of all, the first thing I want to talk to you guys about is doing scaling incorrectly, and one of the most common mistakes people tend to make. So a lot of times when people are scaling in on the market, let's say for example the market is starting to move up, they have actually, I'll get a different color pen now just to make it a bit easier to see. So a lot of times, let's say for example we have a consolidation here in the market. So we see, let's say we've got a resistance, we have a support, and the market's now moving in between this, and then all of a sudden we have a breakout. So first things first, people will generally take their trade right over there on that entry as the market breaks out. Perfectly fine breakout trade, whether you had a buy stop above it or manual execution as the market broke out, or whatever your confirmation was. And then what happens is the market starts to move further higher, and people start to pile on their trades as this market moves further higher. And a lot of people think this is scaling in properly. Now this is actually a really bad way of scaling in, because if we do understand how the market works in cycles. For a lot of you who do trade Elliott wave as well, or if you don't know about Elliott wave, it's just pretty much the market moves in a cycle where it kind of repeats itself over and over, or the market comes down to certain points and then retests to continue further higher. So what will happen here is, if you did enter all these trades here, you scaled in essentially in the market because you think you're on the right way, the market will eventually reach a point where it will pull back and then actually invalidate all these trades, and now you're down way more than you initially were, and you have essentially could have lost a lot more money, especially if the market does dip in a little bit lower and could potentially hit all the stop losses in this trade. So this is a very difficult way to scale in. This is, I believe, is a really bad way to scale in, because this just adds on trading in, because what this does as well is it actually gives you a really bad entry. Now what you have to think about is, let's same example, let's say we've got a resistance, support / resistance zone, market breaks out, and now you scale in, right? But let's forget about the first trade you take. Let's take the scale-ins as, let's say, a new setup, for example. So if the market moves up, right, would you take a trade right over here? Okay, the simple answer to that question is no, because you've already missed the entire move. You have to, the most logical place to put your stop loss to be safe, a little bit safe, would be in here somewhere. If you want to be, 100% safe, well, not 100% safe, but if you want to be, very safe with your stop loss, it'll be below here. So if you look at this risk that we have taken in the market now, it's a very big risk, and if you really look at this trading, it's actually a very bad entry, because you're essentially now doing the exact opposite of what we want to do. We always want to buy low and sell high, but now you're buying high where the market has potentially already reached this peak, and now it's going to drop back down, or could drop back down. Okay, so this is a very bad way of scaling into trading. So let's have a look at the right way to scale into the market. Okay, so essentially what we want to see is, we really want to see a re-entry. So in saying that, scaling might not always happen, or it might not give you the opportunity to scale into a trade. So just be aware, you don't have to scale into every single trade. The opportunity won't always be there. Scaling into a trade is also very uncommon, or not as common, I'd say, in shorter term traders like scalpers, or candlestick traders, like certain day traders, if you don't really follow a trend sort of thing. Because as a day trader or a scalper, you're looking for essentially one candle sort of move, or 2-3 candle sort of moves, where the market doesn't really give you another entry option. Where it would be silly to take a trade, for example, if you have been, if the market's been sitting at a resistance, for example, and the market all of a sudden, or at a support all of a sudden, and we get a big wick and the market pushes up, obviously you're going to take your trade and exit as soon as you reach a certain target. There's no real opportunity for you to scale into this trade. Okay, so just be aware of that. Generally speaking, if you are a day trader and you trade, let's say, on the 5-minute term time frame, or very rarely on the 1-minute term time frame, and you see market structure, then you can start to scale into the market. But if you're trading candlesticks and stuff like that, scaling in might not be the best option for you, because it's going to be very hard to find a place to take a valid entry. Now, The big thing about scaling, guys, is essentially you need to find another entry in the market. You need to find another place where you take another trade, because essentially what you're doing, you're literally taking another trade instead of, let's say, for example, taking an execution. You're actually just adding on with the other trade, if that doesn't make sense. So let's have a bit of an example just to clear things up a bit. So we'll go back to example number 1. Let's say the market has obviously come back down. We're sitting at a major support. We started to see some consolidation, and the market is now broken past. I personally like to take breaks and retests. So the market is retested here, and there is my entry number 1. Okay, so I've got my first entry right over here. Entry, and then stop loss for me. This is why I like breaks and retests. I can put my stop loss below that retest. So that's trade number 1. Okay. Now, I'm not going to take a trade as soon as this market starts moving in my direction. I'm not going to just take another trade straight away, okay? What I want to see is I want to see another entry in this market. So if this was a significant amount of, let's say a significant top, for example, if not just a small little correction, but if we do have a significant resistance area here, what I want to see is obviously we now have created another support/resistance zone. So if the market pushes back past it, retests it, I will then again look to take another trade right over there when I get my confirmation. And stop loss will then be moved below here. And obviously I'm going to take this stop loss because I need to protect myself. This stop loss over here, I'll move it into that stop loss over there. Okay, so now I've secured some profits, and I've also taken another trade. Now, generally speaking, when I trade, whenever I trade, I actually don't risk more than 2% per trade, right? Okay, so what I do personally is when I take the first trade, this initial first trade, I'll risk 2% on that trade, and whenever I scale in on the market, I'll take a 1% risk every trade. So this second trade will be a 1% risk, because if the market does come stop me out, right? Stops me out, I'm not going to bite too much into this profit because this one might be at 1-to-1. So if I take another 2% risk trade, I will lose everything. So if I just risk 1% on the next trade, I might actually come out of that trade with a little bit of profit on hand as well. Okay. So now again, I'll be looking for other sort of structures. So if the market breaks past, I might get something along the lines of a flag, something along the lines of this. Okay. Market breaks out, and there's my next entry. Entry. As soon as we break out, obviously stop loss below, let the market run, and then obviously we're going to have to protect ourselves. Let's move both our stop losses back up to there to protect our capital. So now what we've done, we have secured this position over here. We have position number 1 secured, position number 2 secured, and now we're ready for position number 3. Now obviously I'm not going to keep going and keep going and keep going, because at the end of the day we will eventually reach a target zone where we have to say, okay, now I can start closing my positions. So now that let's say the market's now reached, so I've entered my trade, and what I'm going to do is I'm going to execute and close all my trades right over here as I hit my target. Okay, eventually we need to realize now's enough, I've got enough out of the market. But what this is now helping me, because I've entered with this, I've essentially got, my first trade was initially 2%, my third trade was again another 1%, second trade 1%, and my last trade was another 1%. So essentially what I've done here, I have now had a 4% risk trade. Not really, but I had, an extra 4% add on. So I've essentially potentially have doubled, or at least, times 1.5 of what I would initially have made if I just took a single trade. But for me, I find this extremely important to risk that 1% per trade instead of the normal 2%. If you're risking 1% on your initial trade, you can maybe cut that down to 0.5% per trade, which could be a good option. But this is essentially how we scale in on the market, okay? So the big thing that we want to be looking for when we do scale in is we want to see another entry, okay? That's very, very important. because we can't just take a trade blindly. A lot of people think, like I mentioned earlier, a lot of people take trades just blindly because the market's starting to move in their favor, which is completely wrong. Okay, to put it in a bit of a better perspective, this is how some people scale in. Okay, we're in this beautiful range where the market's moving inside this range. People now, you know, they would take a trade here. So trade, market moves, trade, market moves, trade. You know, there's no real re-entry in here. So essentially what they do now, there's nothing confirmation. The market could very easily do this and take them out and stop out all those trades. So instead of doing this, quick recap, what we want to see is we want to take it, obviously, first trade. Market might create a structure, comes back down to that structure. Trade number 2, obviously move stop loss to break even. We see another resistance here. If you want to trade breakouts, it's fine as well. Or if we get something like a flag play out, like I mentioned before, breakout, again, there's another trade. So we don't just want to be taking trades blindly as the market, you know, moves and doesn't give us any structure. So we always want to make sure that our second trade or our scaling in trades are actual market signals, or are actually following our trading entry rules, and instead of just taking blind trades. Okay, so if you guys did enjoy it, like I said, if you learned anything, make sure to smash that like button, guys. Also subscribe to the channel. Leave a comment down below if there's anything you want us to discuss, or if there's any sort of trading technique you want us to talk about, or any pairs you want us to analyze. We'll be happy to do those as well, guys. Always happy to see the feedback, good or bad. Let us know down below in the comment section, and we'll get back to those, guys. From us here at BlackBull Markets, thanks so much for watching. Stay tuned, trade safe.